Something didn't add up. While inflation stayed high, while debt levels kept rising, and while financial stress quietly spread through the system, gold and silver suddenly moved down instead of up. For anyone watching the markets closely, that moment felt confusing. Weren't gold and silver supposed to protect against instability? Weren't they supposed to rise when confidence weakened? Yet prices fell. And that's exactly why this moment matters. Because this wasn't a rejection of gold and silver. It was a sign that the system needed something more urgent than protection. It needed liquidity. Most people look at falling prices and assume weakness, but markets don't always move based on belief. Sometimes they move based on necessity. And when large institutions need cash quickly, they don't sell what they dislike. They sell what they can. Gold and silver are liquid. They're trusted. They're easy to convert into cash. And in moments of stress, that makes them targets. Welcome back to the Economy Watch. I'm Daniel Carter. On this channel, we focus on what's really happening beneath the surface of the global economy, especially when price action seems to contradict common sense. And before we go any further, take a moment to like this video and subscribe to the channel. It helps the Economy Watch reach more people who want clarity instead of noise, and it ensures you don't miss important breakdowns like this one. To understand why gold and silver were pushed down, you have to understand how modern financial stress actually works. When pressure builds in the system, it doesn't always show up where people expect it. It shows up where leverage exists, where obligations collide, and where cash suddenly becomes more important than long-term positioning. Liquidity is the lifeblood of the financial system. When liquidity is abundant, markets feel calm, prices float higher. Risk is tolerated. But when liquidity tightens, priorities change fast. The system stops thinking about protection and starts thinking about survival. In those moments, assets are not sold because they are bad investments. They are sold because they are valuable and liquid. Gold and silver fall into that category. They can be converted into cash quickly, without the same friction as other assets. That makes them useful when obligations come due. This is why precious metals often behave differently during liquidity events. Instead of rising immediately, they are temporarily pushed down as capital scrambles to meet short-term needs. Margin calls, debt servicing, and risk reduction force selling. It's not emotional, it's mechanical, and this is where many investors misread the signal. They see falling gold and silver prices and assume confidence has returned. In reality, the opposite is often true. Stress is increasing, not decreasing. The system is under pressure, and it's extracting liquidity wherever it can find it. What makes this moment especially important is how quiet it was. There was no official announcement saying liquidity was tightening, no warning that stress levels were rising. But the behavior told the story. When assets that are normally held for safety are sold aggressively, it's a sign that something deeper is happening. This is not a new pattern. It's a recurring one. But every time it happens, it catches people off guard because it goes against simple narratives. Gold and silver are not immune to short-term selling pressure. In fact, their reliability makes them vulnerable during liquidity squeezes. In this breakdown, we're going to walk through why gold and silver were pushed down, what liquidity stress really looks like, and why these moves often say more about the system than they do about the metals themselves. Not with complex jargon, and not with hype, but with clear logic that actually explains what you're seeing. Because once you understand liquidity, price action starts to make sense, and moments that once felt confusing start to feel revealing. Stay with me, because this story doesn't end with falling prices. It begins there. Liquidity is one of those words that gets used constantly in financial conversations, yet very few people stop to think about what it actually means in real life. At its core, liquidity is simple. It's the ability to turn something you own into cash quickly, without taking a major loss. And in moments of financial stress, liquidity becomes more important than almost anything else. When markets are calm, liquidity feels invisible. Trades happen smoothly. Prices move in predictable ways. There's always a buyer on the other side. But when stress enters the system, liquidity starts to dry up in unexpected places. Suddenly, not everything can be sold easily. Risky assets lose buyers. Volatility spikes. and cash becomes scarce. This is when priorities shift. Institutions, funds, and large players stop thinking about long-term positioning and start thinking about immediate obligations. Margin calls have to be met. Loans have to be serviced. Exposure has to be reduced. These pressures don't wait for better prices. They demand action. In that environment, the most liquid assets become the most valuable, not because of their upside, but because of their reliability. Gold and silver are among the most liquid assets in the world. They are globally recognized. They have deep markets. They can be sold almost anywhere. That makes them incredibly useful when cash is needed fast. This is why gold and silver are often sold during liquidity events. Not because they failed as stores of value, but because they succeed as sources of liquidity. They do exactly what they're supposed to do. They provide access to cash when it's needed most. It's also important to understand that liquidity stress doesn't hit all at once. It builds quietly. A few margin calls here, a few tightened credit lines there, a few risk limits breached behind the scenes. Most of this happens out of public view, but the effects eventually surface in price movements that seem counterintuitive. Another key point is that liquidity events tend to be self-reinforcing. Selling begets more selling. Falling prices trigger more margin calls. That creates a feedback loop that pushes liquid assets lower, even if nothing has fundamentally changed about their long-term value. This is where emotions can mislead. Investors see red and assume something is wrong with the asset itself. In reality, the selling pressure is often coming from elsewhere in the system. The asset is being used as a tool, not rejected as an idea. Gold and silver sit in a unique position during these moments. They are trusted enough to be held for protection, but liquid enough to be sold under pressure. That combination makes them vulnerable during the early stages of liquidity crunches. Understanding this distinction is critical. Price action during liquidity stress tells you more about the health of the system than the quality of the asset. When gold and silver are pushed down, it often means stress is rising, not fading. This is the context most people miss. They see the move, but they don't see the cause. And without understanding the cause, it's easy to draw the wrong conclusion. As liquidity pressure continues to build, the reasons behind selling become more revealing. And that brings us to the deeper forces that specifically pushed gold and silver lower, even as long-term risks remained unresolved. When liquidity tightens, selling is rarely voluntary. It's forced, and forced selling follows very different rules than normal market behavior. To understand why gold and silver were pushed down, you have to look at what happens when leverage meets stress. Many large market participants operate with borrowed money. Leverage amplifies gains in good times, but it becomes a liability when prices move the wrong way. When that happens, margin calls are triggered. More collateral is required immediately, not later. And if that collateral can't be provided in cash, assets have to be sold. In those moments, institutions don't sell what they think will underperform in 10 years. They sell what they can sell right now. Assets with deep markets and reliable buyers become the first source of liquidity. Gold and silver fit that profile perfectly. This is why precious metals often experience sharp drops during periods of financial stress. They are being used to plug holes elsewhere in the system. Losses in one area are offset by liquidating assets in another. It's not a statement about confidence in gold or silver. It's a statement about urgency. Another layer to this pressure comes from risk management rules. Funds have limits. Banks have thresholds. When volatility rises or correlations break down, those rules force exposure to be reduced. Again, the easiest way to reduce exposure is to sell liquid asset. This creates a cascading effect. One fund sells to meet a margin call that pushes prices lower. Lower prices trigger margin calls for others. The cycle continues until enough liquidity has been raised to stabilize the system, at least temporarily. What makes this especially confusing for observers is timing. These sell-offs often happen when the long-term case for gold and silver looks strongest. Inflation is high. Debt is rising. Confidence is shaky, yet prices fall. Without understanding forced selling, this looks like a contradiction. In reality, it's a confirmation of stress. There's also a psychological element. When people see gold and silver falling, they assume fear is leaving the market. But during liquidity events, fear is often at its peak. It's just being expressed through selling rather than buying. This is why price action alone can be misleading. It tells you what is happening, but not why it's happening. And the why matters more than the what. Another important detail is that forced selling doesn't discriminate. It doesn't care about fundamentals. It doesn't care about narratives. It only cares about raising cash quickly. That's why these moves can feel sudden and aggressive. Once the immediate pressure passes, behavior changes. Selling slows, prices stabilize, and then the market starts reassessing value based on longer-term factors again. But during the event itself, liquidity overrides everything. Gold and silver were pushed down not because they failed, but because they worked. They provided liquidity when the system needed it most. And that leads to a critical realization. If gold and silver are being sold to raise cash, what does that say about the assets that couldn't be sold? And what does it say about the broader health of the system? To answer that, we need to look at the illusion created by falling prices and why weakness in metals is often misunderstood. One of the biggest mistakes people make during liquidity-driven sell-offs is assuming that falling prices equal falling value. In normal conditions, price is often treated as a reflection of confidence. But during liquidity events, price becomes a reflection of urgency. And those two things are not the same. When gold and silver are pushed down in these moments, it doesn't mean investors have stopped believing in them. It means they are being used as tools. Tools to raise cash. Tools to meet obligations. Tools to stabilize portfolios under pressure. That distinction is critical because it completely changes how you interpret what the market is telling you. If gold and silver were truly losing relevance, they wouldn't be sold first. They would be ignored. Illiquid assets would be trapped. Risky assets would have no buyers. But instead, what we often see is the opposite. The most trusted, most liquid assets are the ones being liquidated, precisely because they can be. This creates an illusion of weakness. Prices move lower, headlines turn negative, and sentiment shifts. But underneath that surface-level story, the reasons for selling are mechanical, not emotional. Once the immediate need for liquidity is satisfied, those pressures ease. Another important factor is how paper markets amplify these moves. Futures contracts, leveraged positions, and algorithmic trading can exaggerate price swings during stress. Selling begets more selling, not because fundamentals have changed, but because rules and models demand it. That's how short-term dislocations form. Meanwhile, physical markets often tell a different story. Availability tightens. Premiums remain firm. Long-term holders don't rush to sell. That divergence between paper prices and physical behavior is a strong signal that value hasn't disappeared. It's just temporarily obscured. This is why experienced observers pay close attention to context. They ask why prices are moving, not just where they are moving. Liquidity events distort signals. They compress time. They force decisions that wouldn't be made under normal circumstances. It's also why these periods are often misunderstood in real time. By the time clarity returns, prices have already adjusted. Narratives catch up after the fact, not during the event itself. Gold and silver have been through this pattern many times. Sharp sell-offs during stress, followed by stabilization and reassessment. Each time, the short-term move reflects pressure in the system, not a rejection of the asset's role. Understanding this helps separate noise from signal. It allows you to see falling prices not as failure, but as evidence that the system is under strain and reaching for liquidity wherever it can find it. And once you see that, the next question becomes unavoidable. What happens after the liquidity pressure eases? Because history shows that the aftermath often looks very different from the moment of stress. Once liquidity pressure begins to ease, markets don't snap back instantly. They pause. Selling slows. Volatility settles. And only then does the market start asking a different question. Not how fast can we raise cash, but what is actually worth holding. This is where gold and silver often change behavior. When forced selling fades, prices stop reacting to margin calls and start responding to fundamentals again. Inflation, debt, monetary policy, and confidence return to the center of the conversation. And when those forces are still unresolved, precious metals tend to find support. History shows this pattern repeatedly. Liquidity events create sharp, confusing sell-offs. But once the immediate need for cash is met, the reasons people held gold and silver in the first place come back into focus. Protection, stability, preservation of purchasing power. Those needs don't disappear just because a liquidity squeeze temporarily distorts prices. Another important shift happens in psychology. After stress passes, participants reassess risk differently. The experience of forced selling leaves a mark. Confidence in leverage weakens. Trust in financial stability becomes more cautious. That often leads to renewed interest in assets that are not someone else's liability. Gold and silver benefit from that reassessment. They don't depend on earnings, forecasts, or counterparty promises. Their value is not tied to the health of a single institution. That independence becomes more attractive after periods of stress, not less. At the same time, physical markets often tighten further after liquidity events. Selling pressure may have hit paper markets hard, but physical supply doesn't magically increase. In some cases, it decreases as long-term holders absorb metals sold during the panic. That dynamic can create a foundation for recovery that paper prices initially failed to reflect. It's also worth noting that liquidity events tend to leave systems weaker even after they pass. Debt doesn't disappear. Structural issues remain. The same pressures that caused the sell-off in the first place often continue working quietly in the background. That's why repeated liquidity events become more likely over time. This is where perspective matters. Short-term price action tells you about stress. Long-term behavior tells you about trust. And trust, once shaken, is slow to rebuild. Gold and silver don't need perfect conditions to perform. They need uncertainty. And uncertainty often increases after systems are forced to reveal their vulnerabilities. So when you step back and look at the bigger picture, these sell-offs start to look less like endings and more like transitions. Moments where the market sheds excess leverage, resets expectations, and prepares for the next phase. And that brings us to the final and most important part of this story. What all of this means for understanding markets, risk, and awareness moving forward. At the end of the day, what happened to gold and silver wasn't a failure of the metals. It was a revelation about the system. When liquidity becomes scarce, even the strongest assets are pulled into the storm. Not because they've lost their purpose, but because their reliability makes them useful in moments of stress. This is why understanding liquidity is so important. Without that context, market behavior looks irrational. With it, the pieces fall into place. Falling gold and silver prices during stress don't signal confidence. They signal urgency. They tell you that somewhere in the system, obligations are coming due faster than expected. At the Economy Watch, the goal has always been to help you see beyond surface-level price action and understand the forces driving it. Gold and silver are not just charts on a screen. They are mirrors reflecting the health of the financial system. And during liquidity events, those mirrors show cracks most people don't want to see. This doesn't mean panic is the answer. It means awareness is. Markets adapt, systems adjust, but they don't do it evenly or painlessly. Those who understand why things move the way they do are better equipped to respond calmly instead of reacting emotionally. This is not financial advice. It's perspective. It's about recognizing patterns that repeat across cycles and learning to interpret them correctly. When liquidity stress pushes trusted assets lower, it's worth asking what the system is really trying to tell you. Now, I want to hear from you. Do you think gold and silver sell-offs during stress are misunderstood? Or do you believe they signal something deeper about the future of markets? Drop your thoughts in the comments. Your perspective helps shape better conversations, and I read as many of them as possible. If this breakdown helped clarify what you've been seeing in the markets, share this video with someone who might be confused by recent price action. These insights matter most before narratives catch up. And make sure you're subscribed to the Economy Watch so you don't miss future videos that break down the forces shaping the global economy. I'm Daniel Carter. Thanks for watching. And as always, stay aware.